3, 2, 1.
All right, all right.
All right.
It is the end of the first half.
Of the year.
This is the last trading day of the first half of 24. Unbelievable year for the market so far.
I know. Yeah, I was just talking to someone last night. No, it was yesterday sometime. I don't know. Everything's blurry this week. It's been a crazy week for us besides the market. But, yeah, I was just like, I couldn't believe we were this far into the year and this far into this run, this bull run.
Yeah.
And basically the question started off with, they asked me, like, when do you think it's going to turn? And I'm like, there's just nothing right now to tell us. I don't know.
No.
And then after last night's debate, which I didn't watch, and don't want to get into the politics, that's why I didn't watch it, but, like, everything was crazy this morning.
Yeah.
I couldn't even turn on the TV. I was like, I just don't want to watch any news or anything. Like, I don't want to know.
Well,
as I knew it was going to be a train wreck.
Yeah. I mean, futures were up really big, and that was for sure on the debate, right? PCE came out this morning, and if you had taken out the debate, PCE would have been the whole thing everybody was looking at, because we've been in this really tight trading range for a few days, and PCE could have been the thing that pushed us out of the range one way or the other.
Yeah.
And it looked like we were going to get out of the range today. So it's noon on Friday. So who knows what happens by the end of the day? But if you look at a daily chart with the candlesticks, the market came up and hit exactly the most recent high. So like last week, right? And then reversed, and now it's down. I mean, it was up like 6 or 7 tenths. Now it's back down to like up only like 1 tenth or 2 tenths or something. So, but the debate definitely, obviously people are talking about it, but how it affected the market initially, I thought was pretty interesting. But it just created so many different possibilities going forward that I think the initial tick up was on the idea of some certainty, right? But I think as the talk and the day progresses, it devolved into actually less certainty than there was.
Yeah, I've heard some crazy things this morning, even trying not to listen to the news. Yeah. Just let it play out. All right, what do we got this week?
All right. 30 June 2024. So I got a pretty good question from the Facebook group. We've seen a lot of these kind of similar questions lately, and we'll just take one of them and talk about it for a second. And then something we have not done before, and I don't usually divide the S&P into growth and value, but there's a lot of value in taking a look at that. So we're going to break those out and take a look. And then seasonal mean reversion, question mark. So like we were just talking about, the market is way up this year, and it's up way more than a average election year cycle. So I got a chart from Stock Traders Almanac that was out on Twitter, so I'm sure they won't mind me using that. And then I got a chart of I'm calling it smart money versus dumb money, but it's the high yield growth ETF divided by cash. So when the bond market is basically smarter than the stock market. So people say that the bond market is much bigger than the stock market, and it tends to lead. So when investors invest in high yield, it's a risk on. They're comfortable taking on more risk. If they're investing in cash, obviously they're not taking on risk, right? So when that line goes up and to the right, the stock market usually is also. So I want to compare those two. And then TSP charts. All right. So I've been in the life cycle fund for over 10 years. I have 2.5 years before mandatory retirement. So he's 6C. He's a firefighter. Just moved my money to my TSP money to CNS 50% each. Is this a safe move? So is it a safe move? I thought was the interesting thing. There's nothing wrong with the life cycle funds. I mean, if you're a firefighter, you don't have time to sit in front of your computer and shuffle your TSP around. So that the life cycle funds, that's kind of what it's designed for. And if you've been in it for 10 years and you have 2.5 years before you have mandatory retirement, now if let's say you stopped firefighting or you're in an admin position or something and you have time to look at it, could you move to 50C, 50S at that point because you have time to focus on it? Yeah, you could. Whether or not it's safe is a completely different thing. So basically, my answer to him was, any financial advisor is going to tell you, no, it's not a safe move. I mean, it's not a safe move on the face of it. By reallocating to 50C, 50S, you're undermining the point of the L fund. So if the point of being in the L funds was to, kind of minimize risk, by reallocating to 50C, 50S, you're just completely undermining the whole point of the L funds in the first place. So at the end of the day, though, it depends on how closely you want to watch the market, whether or not you want to actively manage your account, and your personal circumstances and risk tolerance, right? We see this question all the time, and there is no one-size-fits-all answer, right? That's really the bottom line.
Yeah, so it brings to mind, like, you did one of those little short videos yesterday, the day before, like,
Yep.
The bottom line is, if you have to decide, do you want to do the work?
Right.
Do you want to be an active investor? We always talk about this, passive versus active. There are good reasons to be a passive investor. It's not necessarily a bad thing, but it should be a choice. You should be a choice that you made, right? A decision you made based on your circumstances, right? And so if you're passive just to be passive, that's not necessarily a good idea, but you have to make a decision. If I'm going to be actively engaged, I'm engaged. Yep. I'm paying attention. You got to do the work. I mean, this is your money. This is your retirement. This is important. This isn't just a bet on a baseball game or something. Like, this is a big deal, and that's why we do this show. Is because, when we were in this game starting out 30 years ago, nobody was talking about this stuff.
No,
nobody. Much less. Now we've got, at least there's a few people out there besides us that are talking about it, but we didn't have any help, and so. Get engaged. Hopefully you're watching the show.
Yeah.
If you're in our Facebook group, I hope you watch the show. And just get educated.
Back then, there wasn't the 50C, 50S ride or die mentality that there is now.
No. Well, they didn't have L funds either when we started.
They didn't have L funds. The I fund was killing it.
Yeah.
Things were much different back then.
It was very different. It was easier to do because there were less choices. Things have gotten more complicated now, and the world's got more complicated. And that's why we keep saying this. This is not the time to be complacent. So
No.
I don't know, the person's name. Obviously, we didn't put that up there. But if you're watching this, like Jerry said, you want to put it in CNS, fine. Just don't take your eyes off of it,
right,
or you're going to lose your retirement. Literally, it could happen any week now.
Yeah.
And you would go down 30-40%. And you want to talk about...
Could easily happen.
Oh, It would be just so heart-wrenching to know that happened to someone, especially someone that's, hopefully, like, paying attention to us, listening to us.
Yeah.
Hopefully they're at least active enough to do that.
Yeah.
Don't walk away and don't look the other way right now if you're in the stock market.
I mean, where if you're a subscriber to our site, you've been 100% C fund for months. But that doesn't mean that I'm not ready to pull the trigger like tomorrow.
Exactly. And everybody should.
Yeah.
All right.
So growth versus value. So this is kind of goes to what we were talking about a minute ago when I get to the chart. But so there is we're going to get to the ETF for both growth and value, and the ticker symbol in the mutual fund window if you want to do it that way. But this is the top 10 companies by weight in the S&P 500 growth ETF. Okay, so as you probably expect, Microsoft, Apple, NVIDIA, Amazon, right? It's all the Magnificent Seven. You got Eli Lilly in there, and Broadcom, and the rest of it is, stocks that are in the news every day. So that's the growth half of the total S&P 500. This is the top 10 constituents of the value. Okay, so you got Berkshire Hathaway, J.P. Morgan, Exxon. It's a much broader. It's a much broader part of the S&P 500 index overall, right? A lot of financial, a lot of energy, but it's completely different from tech. The other one was all tech. This one is much broader. Okay, so if you're going to break up the S&P 500 in two, that's how it would be: growth and value. So here's what it looks like on a chart. Okay, we're going back to 2001. You got the S&P 500 index as a whole in black. the S&P 500 growth, right? It's just the growth half in blue and just the value half in orange, okay? So this is what it looks like if you go all the way back to 2001. And it kind of makes sense that the S&P 500 itself would be somewhere in the middle between growth and value, right? So on the big scheme of things, they go up and down together, okay? So if we break it up a little bit, this is 2009, okay, so the bottom in 2009 to where we are today. So you can kind of see at some point in here, I mean, it was really after COVID, but it started before that. At some point in here, after 2009, growth, which is tech, really started to outperform value, okay? And it just kept on going. Even after COVID, it got more, right? Because those high-tech names just completely took off, and value basically stayed flat, okay? Then, of course, the S&P is somewhere in the middle, right? The overall index is somewhere in the middle. So if you had been in growth, in that growth ETF since 2009, you'd be up 873% versus 620% for the S&P index versus 382%. So if you were in value since 2009, you got half the performance that the index did, and a third of the performance of growth. That's since 2009. If you go back to 2000 and you look at from 2000 to 2009, the picture is completely different, right? Growth way underperformed value. Okay, so the point, and that came because the ETFs don't go back that far. But if you remember back here in 2000, the Nasdaq, which is tech, it's growth, fell 82%. 82%. So I think people don't either remember or don't want to think that could possibly ever happen again or whatever. But as bad as the S&P 500 decline of 50% was, back then the value, right? So this is 2000. So it's pretty close. This is the actual top of the index. So this is the beginning of the downturn. This is the whole market decline into 2003. Even back then, growth was underperforming value. So the Nasdaq fell 82%. The S&P today is much more like the Nasdaq back then. Back then, the S&P was much more dominated by value, and value today is way down, right, versus growth. So what I'm saying is it's absolutely possible that you get a decline in the S&P that's much more similar to the decline that we had in the Nasdaq back in 2000 if it goes in that direction, because the companies that are driving the S&P are the same kinds of companies that were driving the Nasdaq back then. And I'm not, it's not a prediction, it's not a forecast, it's the math. It's the companies that are actually in the index now are different than they were back then, and they correspond more to the index that dropped 82% in 2000.
Right. What we're talking about is probability, right? Anything's possible.
Yeah, anything's possible.
Anything's possible. This is getting more probable and more probable.
By the day.
Yeah.
Yeah. Okay, so if you wanted to play it, growth versus value, IVW is the growth ETF, IVE is the value ETF, and then these are the ticker symbols for the mutual fund window. Okay. Seasonal reversion to the mean. So Jeff Hirsch at Stock Traders Almanac, he's under the Twitter handle Almanac Trader, put this up on Twitter like maybe a week ago. This is kind of fascinating because if we've done we've put up this chart. He updates it pretty frequently. We've done it, over since the beginning of the year. We've done it a few times, and this is kind of the most recent one. So you got S&P 500. We're talking about. It's the seasonal pattern from 1949 to 2023. Okay, so if you take the average election year of all those years, and you go back and look at it, all election years is the black. Okay, the black line. The aggregate is the blue line, so we don't even really worry about that. It doesn't really matter. All election years are the black. When a sitting president is running, okay, the market does way better than the average election year. Okay, so when a sitting president is running, it's in green. And that's where we are right now, right? We have a sitting president that's running. This is what actually has happened so far in 2024. So, I mean, we are way beyond. We're up here at 15% gain since the beginning of the year in the S&P. Way higher than the full year on the best average, right, when you have a sitting president running. The presidential cycle is always a good year. So you're always up, 7% is a pretty good year on any year. And we're up 14, 15% already this year. So, you could argue, I'm going to take it to the bank, right? You could look at it that way and say, I don't want to deal with all this that could be coming for the second half of the year. Take double-digit gains for the year and call it a day and go to the beach. Or you can, keep it on red and power through, right? So his question here is, are we due for a little mean reversion? You always get, you have some chop during the summer, and you usually have this pullback, which you always get going into the election. So we'll see. This year has been just obviously not like any other year election pattern. So, but everybody is looking for some kind of weakness going into the election, whether it starts now or a little bit later in the summer. Basically, the end of August tends to be when that happens. But we're due for a pretty significant correction. It doesn't mean we're going to get it. Who knows what's going to happen? But if you look at it, there's almost always some weakness there. September and October going into the election. And we are way, way above where a normal halfway through an election year would be. So take it for what it's worth. This all goes to don't be complacent, right? That's what we're talking about. Okay, so this is what Jeff Hirsch says about that chart, right? Charts to illustrate 3 relevant seasonal patterns. So the mid-year rally that he talked about this week is still in play, right? Because the market's still going up. But after around mid-July, wouldn't be surprised if we got a pullback, maybe 5 or 8%. There's plenty of plenty on the near-term horizon to spook traders from election campaign and political missteps, Fed speak, economic data, all the stuff that you always have. But after going long last October, we've been advising in our newsletter subscribers over the past few months to take some profits, tighten up stops, generate some cash, and hold some short-term bonds paying 5+% while we wait for a fatter pitch. So what does that mean? How does that translate into TSP? He's advising his people to now you have different options, right? So take some profits. For us, that means move some of your gains from the C fund into the G fund. The G fund is essentially, it's not paying 5%, but it's doing pretty well. While we wait for a fatter pitch, he's waiting for a correction in the market. It's the same thing Warren Buffett's doing by having half of his portfolio in cash. So there's absolutely nothing wrong with locking in gains,
Yeah, especially if you're risk averse and or you're in retirement like us, and you're not ready to lose 30% of your money. Nobody should be ready to lose that kind of money. But those are the kind of losses that are potentially coming. And so, we're pounding the desk as hard as we can. We're not saying the sky's falling. Nope. We're not making any predictions. All we're saying is just you got to keep an eye on the ball right now. You need to always keep your eye on the ball, but more than ever, right? People tend to kind of glaze over in the summertime, right? Because we all got things going on, and it's summer, right? People are going on vacation and whatever, and that's where the whole saying,
sell and man go away.
Sell and man go away because everybody went on vacation. Nobody was going to, and manage their portfolio when they're at the beach for a month or two.
Yep.
So anyway, take it for what it's worth.
Yep. Yeah, I mean, you don't want to miss the gains. You don't want to miss out on the gains. So don't, right? Stay in the stock funds as long as the market's going up. When the market's not going up anymore, don't be in the stock funds. It's pretty much that simple. It's not easy to do, but it's pretty much that simple. The problem is everybody wants a thing that they can just set it and leave it and get the gains and avoid the losses. That's not possible. Okay, smart money versus dumb money. So this line is high yield growth versus cash. Okay, so when investors are risk on, they're buying more risky assets, bonds in this case, higher yielding bonds, then they're putting the money in cash. So when this line is going up, it's risk on. When it's going down, it's risk off, right? So, and that makes sense. This is the S&P 500 in orange. So when the ratio line is coming down, the stock market's going down. When the ratio line's going up, stock market's going up. Okay. So where's the value for us in this ratio chart versus the S&P? The top going into 2008, right? The market is still going up. But the smart money is getting out, right? It's risk off. At the bottom, you get the smart money coming back in right at the bottom. Then at the top in 11, this is the peak in the ratio. The market is going sideways, right? But the smart money is fleeing. 2015, same thing, right? The market's still going up. Smart money's headed out. Market corrects. Same thing going into COVID, which I thought was really interesting. The market's ripping going into COVID, and the smart money is not buying it, right? Going into the top in 2022, market's going up, smart money's getting out. And where are we right now? I wouldn't call that actually a rollover yet, but it certainly looks like it's going in that direction. And as we know, the S&P is just continues to make new all-time highs. So again, take it for what it's worth. The smartest guys in the room look like they're leaving. And so these are all just big red flags. It doesn't mean that none of them are timing tools. They're just big red flags, so that you're not complacent and you're anticipating and you're watching. And when the market validates all these things, you just reallocate to the G fund. It's simple. You're not trying to top tick the market, right? Nobody can do that. But it pays to be prepared. Okay, TSP fund charts. So, like we said, on a weekly basis, right? This is a weekly chart of the C fund, S&P 500. There is absolutely nothing here that would tell you to be out of the market. This one is a little bit different than what I usually do. This is actually a 50-week moving average. It's not a 20-week. So we had a question on the member-only call that we did this week. Why do we use a 20-week moving average? You know, why that number? So the idea is to pick a moving average that gives you the most support. So by doing the 50 on this, it gave us a better support level, right? You didn't have as many whipsaws. So basically what I'm saying is if and when price gets down here below that 50-week moving average line, I mean, this is going back to 2009, right? So it would be something like that. Not good. Until then, the trend is up. I mean, the trend is up. You know what? That was a mistake. This is monthly. This is a monthly chart. I forgot that I did this because it's the end of the month. And so, yes, 50-month moving average. The one thing I wanted to point out about this is we basically have 3 months of consolidation right there. And then in June, we had a breakout. That's really bullish. You know, so yes, you have to be prepared and all that, but on a monthly basis, that looks really, really good. Okay, weekly, we're back to the 20-week moving average line. There's nothing to look at. I mean, it's going straight up. S fund, we had put this bottom in last October, had a run up. We are in this triangle consolidation right now. As of now, it's in this triangle consolidation. Until it breaks above here or below here, there's no point in trying to catch any of those moves in there. Until it goes one way or the other, you don't know which way it's going to go. iFund 82 is the magic number. It hit 82 3 times back here in 2021. Came up here most recently and hit it 1, 2, 3, 4 weeks in a row, and then got rejected really hard a few weeks ago. And so iFund isn't even worth looking at until it gets up here at like 83. And the F-Fund still is the best chart of the mix. We have a historic bottom down here and a huge breakout a couple weeks ago that looks like it's working. So the F-Fund is the best looking chart, but it doesn't mean that you would make the most percentage gains in the F-Fund as long as the C-Fund is still going up. That is all I got.
Well, that's a lot.
Yeah.
If you like what you see, please share it with your friends. If you have any questions about today's show or anything we talked about, you can hit us up in the comment section. We periodically check the comment sections on wherever you find this video, YouTube, Facebook, Instagrams, and all that.
Yep.
The grams. Hope you guys are having a good weekend. We will see you next week.
That's it. 4th of July next week.
Bingo.